Hey everybody, welcome to another live episode of Be the Boss of Your Money. If you're interested in learning about personal finance, literally becoming the boss of your money so you could be better in life, you've come to the right place. We're all about personal finance here. We talk about things like investing, debt management, buying a house, retirement planning, financial planning. We cover it all. Today's specialty is what lurks behind, or I should say, what lurks beneath the surface. That's why I had that picture of a shark poking his nose just above the surface in the thumbnail picture, because it looks like the seas are calm above the surface, but when you get beneath the surface, there is something going on in the market. I don't like it. You don't like it, but we need to talk about it to make sure that we're okay. It's not so much that this is a long-lasting issue. It's really more a matter of that if you understand it, you won't panic sell and ruin what otherwise would have been a very good plan. So let's get into it. Let's roll the intro. We've got a couple things to talk about. Quick update. Just feel like we've got to catch up on a whole bunch of things. Oh, and by the way, the VIX, we talk about that here every day, is below 20. Something we all wanted to see. And now nobody's talking about it because this hedge fund, Archigo, is just sucking up all the oxygen in the room. Here we go with the intro. Stick around. This is going to be really good. So let me ask you a question. How many cups of coffee a day do you drink? This has got to be like number 6 for me. What can I tell you? I drink a lot of coffee. I could use more sleep. You know, when you drink a lot of coffee, the impact of the caffeine just starts to go away. So I guess you need more and more of it. But I do love coffee. I love the way it makes me feel. I love the way it tastes. I love coffee. Do you love coffee? Let me know in the comments. So welcome to you if you're watching this in the live stream. If you have any questions, you know what to do. Ask me in the comments. That, to me, is the best part of doing this. When you are asking questions, I love that. And we get into some back and forth. I answer your questions. I make things more clear for you. And if you are watching this in the replay, welcome to you as well. If you have any questions, certainly ask me in the comments. I will see those and I will get back to you. And for everybody out there watching this, whether live stream or replay, your words of encouragement, words of advice, words of appreciation, words of gratitude, they are all welcome here. So go ahead, hit me up in the comments. Let's get into a really good show. We've got a bunch of people out there watching. I could see how many people are watching. Hey, listen, if you give this stream a thumbs up while you're watching, I'll be able to see who you are. I'll be able to see your name, and I would love for you to do that. So go ahead, give me a react, maybe give me a little heart, a thumbs up, I don't know, if you're on LinkedIn, celebrate. By the way, if you're watching this from YouTube land, then I want to thank you. Jillian is out there so far. Thank you so much, Jillian. By the way, I am now Jillian's client. Jillian taught me so much about FaceTime, Facebook metrics, Facebook business metrics. So I really appreciate that. I'm looking forward to working with you a lot more, Jillian. I learned so much, and I can't wait to put it to use. So let's talk more about a couple of things. So my footrest just moved. I hate when that happens. Okay. What the heck is going on in the market? So far, I think, given the size of this hedge fund that just blew up, Archigo, excuse me, not Archipelago, Archigo, I think the market's handling this pretty well. I think that what this means for you is there is still so much stupidity in terms of what professional money managers and banks in terms of what they're doing. So let me just reiterate. You can find a lot of information on this online, but I want to give you my point of view. I already see somebody out there in the comments. Josh loves, man, you and me, we love ourselves some coffee, right? Oh, I'm gonna get another cup of fresh cup of coffee right after this live stream. Josh, thanks so much for joining me. And we've got a few more people out there. Andrew is out there. Andrew Janisic, thank you, of Proforma. If you need any printed, if you need any like PR stuff, shirts, logos, things like that, you go to Andrew Janisic. So let's get into this. Archigo is a family office. It's really a hedge fund. The person who runs it, Bill Wang, somehow was able to leverage up his fund to such an extent that he pushed some major stocks up. Like, we were all wondering in the industry, like, how the heck did Discovery Communications, the Discovery Channel, how did that stock just take that quick leap from like 45 to 75 in no time flat? And why was Viacom CBS the number one performing stock in the S&P 500 up until about a week ago? By the way, the S&P 500, it's an index. You know it. You can't invest directly into an index, but you could invest in a security that tracks or mimics an index. Boom. Okay. And my friend Josh Barron is out there. Josh prints stuff. Josh is like, a print broker as well. Thank you for reminding me, Josh. And I just greatly appreciate that you reminded me so I could give you a shout out. Thanks, buddy. So how did he do this? It's just so stupid that when somebody has large positions in a stock and borrows money to buy more stock, let's say you have $1 to buy stock, but using very opaque derivatives and dark pools, you could buy $10 worth of stock. So this, I mean, from what I understand, this person leveraged up more than 10 to 1, maybe 100 to 1. And his fund, in my opinion, was bound to blow up eventually when the right spark came along, the right spark. The spark in this case was a secondary offering, a stock offering of $3 billion of Viacom CBS led by Morgan Stanley and JP Morgan. And that was the spark that sent the stock down because there were just not enough buyers to keep supporting that stock. Bill Wang couldn't buy the whole $3 billion float and keep buying the stock. So if anything, when you're really leveraged, if your stocks go down just a little, you get what's called a margin call. And that's when your brokerage firm calls you up and says, you've got a margin call, you've got to raise your equity, and, send us a ton of money right now. We're going to sell you out. And he's like, and what happened is American banks started selling it out. Morgan Stanley, Goldman Sachs, they didn't really get dinged too badly. JP Morgan avoided this whole fiasco altogether. The stock started to go down. And then the two main prime brokers, the main banks, Nomura and Credit Suisse, for this hedge fund, they got smashed. Billions of dollars of losses. Terrible risk control. And it just took a number of well-known stocks, destroyed the stocks. The stocks got crushed. Most people, by the way, most investors like yourselves, you're not even going to notice unless you own these stocks. So here's my problem. Is it fair that someone could lever up so much that when they have a problem, that they bring the rest of us down with it? Something similar played out with GameStop, if you recall, about 2 months ago, a month and a half ago. GameStop stock took off. It went from like 10 to 20 to 30 to almost 500. I forget the exact 480, 500, something to that effect. And a number of hedge funds who were short the stock started to lose money so badly, they were doing so poorly, that they could have gone out of business. And then some hedge funds had to borrow from other hedge funds and get bailed out. So what the heck is going on with these hedge funds? So I think there's going to be a call for greater regulation of hedge funds, dark pools, and opaque derivatives. I remember in 2010, Procter & Gamble went from like $70 down to like $1 in a matter of minutes. Experienced investors, market soothsayers, we knew that there was something odd. It wasn't legit. But these mistakes happen once in a while, and they mess up our heads. Maybe they mess up our portfolios. And if you didn't know better, Discovery communication stock, as an example, should not have been as high as it was. But they're playing, it's affecting you. It's affecting your stocks. It's affecting stocks in the major benchmarks. So that's what I think. Elizabeth Warren, who is on the very powerful Senate Banking and Finance Committee, she is, look, she's definitely going to use this to pound the table. And she could also pound the facts that there's something definitely wrong. So I think things are going to change for the market. And I actually think that they could, change. I think the goal is to make the market a more stable in terms of its functioning. So I see some big changes. Now, Jay, who is also a hedge fund manager, says, hi, many of those Procter & Gamble trades got, yes, those Procter & Gamble trades from 2010, they pretty much all got canceled. And yes, this is a more systemic problem. I agree with you. Thank you. And yeah, those Procter & Gamble trades got canceled, but it lends credence to those who say the stock market is rigged. It's it ruins how do I say this? It ruins the stock market for the rest of us. I'm not looking for action in my clients' accounts, roll that dice and give them a throw. That's not what I'm looking for. My clients aren't looking for that. I mean, even though I have full discretion in my clients' accounts, that doesn't mean I get to do anything I want. It means I still have to live up to the client's expectations and definition of risk tolerance, time horizon, financial goals. And when you see a stock go from 40 to 75 back down to 40 in a matter of days because some hedge fund blew up, I don't have a problem if you want to leverage yourself up and blow yourself up. I just don't want it to affect my clients and me. That's all. And I think that's the problem that we're having with a lot of these hedge funds, with GameStop. And these things are happening with greater regularity. And it's not just like, well, how often does this thing happen with this Bill Wang guy? Well, it happens. Each case is different enough to say it's a one-time event. But after a while, one-time events do add up. Okay, I want to talk to you about cryptocurrency. I put out a poll about, would you buy a Bitcoin ETF if one were to become available in the United States? And I haven't looked since last night, but it was very close, half saying yes, half saying no. I think I've got like probably close to 200 votes, which I think is pretty good for a LinkedIn poll, if in my opinion. And just the no's, the no I wouldn't had a slight edge over the yeses. And I'm connected with a lot of financial advisors, and most of the content that I see, that I interact with, the people I interact with, we're mostly financial advisors. We're like the financial advisor group of LinkedIn. We're all content creators. And this is going to be a big question. I think a crypto ETF, it could just be a Bitcoin ETF or just a general crypto ETF. I think some of these, I think an ETF in this space is imminent. I think it's bound to happen, and it's bound to happen pretty soon. I saw that PayPal is now willing to accept on the spot crypto, but they'll like rapidly exchange it for money, for regular currency. Okay, just so you know, crypto is not a currency. Now, people call it the currency of the future, and people who trade it say it's like money. It's not. According to the IRS, crypto is property, like a stock. So when you sell crypto, it's a taxable event. Now, if you buy something for $100, presumably you pay taxes on that $100. That's why you have the $100. You earned $100. So maybe you had to earn $110 $30 and you have $100 left over after taxes, and you exchange that $100 for a meal at a restaurant, well, you pay a sales tax depending on which state you live in or what county you live in, but there's not a tax. There's no tax on the dollar. No one say, well, you owe another 20% capital gains in the dollar. You already paid your taxes in the dollar. But if you use crypto, you'd say use Bitcoin to pay for something. If you paid $50 for the Bitcoin and you sell $100 worth to buy something, $50 of that transaction is a taxable event. And if you had the crypto for less than a year, then you have a $50 short-term capital gains tax, which is taxed at your ordinary income tax rate. So just be careful when people start talking about, oh, you could use crypto to buy things. It's like basically you're selling crypto, paying the taxes if there's a capital gain, and then using what's left over to buy something. Just so you know how that works. I know you could donate appreciated stock to like a donor advisor fund, the donor advised fund. You could give away appreciated stock to a donor advised fund. I don't know if there are any charities or philanthropies or donor advised funds that will actually accept Bitcoin. It would be pretty cool if that were true, if that was happening. But let's go on. So in my mind, I'm trying to rectify how I would approach a existing client or prospect with a ETF in crypto, because it is highly speculative. And I'm just wondering how I would do that. Probably would have to, no matter what, discretion or not, have the conversation with the client first. Maybe get the client to sign something. Okay, maybe. But I do think it's on the way. And I think it changes a lot of things. I see crypto play money becoming legitimized by lots of corporations starting to use it and accept it. I still don't have my arms wrapped around it because there's still no basis to it or intrinsic value. There's no government backing. There's no rule or law that says you have to accept a crypto. It's not legal and tender. It's this whole thing takes a while. And keep in mind, all of the crypto that you see now, all of it might just be a grand experiment to make way for new cryptos that haven't even been invented yet. And then, of course, central governments could ban crypto, or they could come out with a crypto of their own. My opinion, this is really controversial. My opinion is the only reason to use crypto and actual cash money in any transaction is to avoid paying taxes. What do you think of that? Yeah, listen, I know there's a convenience factor. You have a $20 bill or a $5 bill. You want to buy a cup of coffee with a $5 bill. I get the convenience factor. You've got some cash. But when people are transacting business for $5,000, $10,000, $20,000, $30,000 in green, that's because they don't want the IRS to know about the green. I can't think of any other reason why anybody would use tens of thousands of dollars of cold cash for commerce other than to avoid some kind of, other than to avoid paying taxes. That's how I feel about it. And I see the same thing with crypto. Now, some people say crypto is an investment. Some people say it's a currency. Some people say it's a store of value. Some people say all three. And some people say by its very nature, there is no store of value in crypto except for the FOMO trade, right? Fear of missing out. So we have to get into that. And I think we'll be talking about that a lot more. But I do think it's a significant topic. And that's why I want to talk about this. Yeah, Josh, you use Bitcoin to buy your fighter planes. And this way you kind of fly under the radar. You get it? Fly under the radar. A little pun there. Yeah. Ooh. Okay, so let's take a look at how the market did today and why is the market holding up. The thing that lurks beneath the surface is this weird hedge fund thingamajig, and there's something else that's beneath the surface. Why haven't stocks corrected? The the reason stocks have gone up during the pandemic, the reason given, and this is the reason I give, and it is, to me, it is my reason, is the stock market does not necessarily reflect the economy. The stock market is measured by the S&P 500, again, an index that you can't invest directly into, but you could invest in a stock or some security that tracks or mimics the index. I feel like I have to say that every time I say S&P 500. So the S&P 500 reflected during the pandemic the performance of the largest companies, and that's Amazon, Facebook, the stocks I talk about all the time, FANG-M. So Facebook, Amazon, Apple, Netflix, Google, Microsoft. Those stocks were also ideally suited for a pandemic, for a economic shutdown, work from home, stay at home. So those stocks, they took off and it brought the market up. And then consumers are scratching their heads thinking, why the heck is the stock market flying higher when the economy is just constantly falling apart? Why would that be? It's because the best performing stocks were also the biggest stocks, and they went up. And since bigger stocks have a bigger impact on the S&P 500 than smaller stocks, because the S&P 500 is a market cap weighted index, the stock market went up. So now we have this rotation, reflation trade. Economy's opening up. People are going into economically sensitive stocks, industrials, materials, financials, energy. Well, we thought the money was going to come out of the work from home, stay at home stocks. So while those big stocks went down and the tech sector went down, the rest of the market would go up, and maybe the market would be kind of balanced out. And it didn't happen. The market's kind of just staying. Well, in a way, it did happen. It's kind of staying still. But what I'm saying is the reason the stocks aren't going down, because the industrial stocks don't go up every day. They're definitely volatile, and some of them have gone up a lot and already have come down a bit. But you have to take a look at these 6 big stocks that we took a look at before. So let me show you a couple of things. I'm going to do a share screen. Let me just change up my screen, okay? Okay, I'm up here in the corner, and that is the screen. There we go. I'm up here in the corner. I want to show you. Let's take a look at Google. These are the 6 big stocks in the market, the 6 heavyweights, the biggest companies in the U.S. markets, in the S&P. Stifel upgraded Google today to a price target of $23.50. JP Morgan yesterday made Amazon a top pick with anticipating over the next year a 45% rally. So as big as Amazon is, about $3,000 a share now, they see 35, about 3,000. They see maybe $4,500 price target. Facebook just got a whole bunch of upgrades, and they're just killing it. And the worries about a breakup of the company have started to dissipate. Apple just has so much cash, and they're fine. Microsoft is doing very well. So these stocks, if you look on the right side of the screen, I'll make this a little bigger. Maybe it'll be easier to see on your smartphone there. Okay. If you see on the right side, the ranges from the 52-week range, the red bars are mostly pretty small. These stocks have held up quite well, considering there's a rotation, reflation trade going on. All right. And let's take a quick look at the rest. The Dow is off 104 points. The NASDAQ off 14 points. S&P off a little bit. No big deal. Oil was off $1.15. Gold is coming off a little bit. The fact that gold's coming off a little bit, gold is the inflation signal. And gold is not really signaling inflation. People say that crypto, Bitcoin, is the new gold. So if crypto goes up, if Bitcoin goes up, that means that signals inflation. I'm still not entirely sure why Bitcoin is going up. Is it just because people see it going up, so they want to own a piece of the action? Look, do you invest in something first because it's going up, and then look for reasons to justify your purchase? Or do you look for the reasons to justify a purchase or not, and then buy? There's a very big difference, because the first one means you're chasing performance, you're momentum trading. The second one means you're buying on some form or kind of investment thesis. Okay. 10-year yield was up a little bit today, about 175, but it closed off a little bit. The VIX, see, it's 19.61, down at 1.13. We've been talking for the longest time, other professionals, that if the VIX could get below 20, we'd have a big rally, because that would be like an indication of safety into the stock market. It would bring in a whole bunch of new money, and it would bring in the quants. Okay. It hasn't really happened yet. So we'll see if we'll see how that works. And let's take a look lastly at the most important thing I look at every day. And if you want to check this out for yourself, then you should definitely do so. What I'm looking at here are the sectors, the 11 sectors that represent the 11. Maybe I should share my screen. Okay. What I'm looking at here right now are the 11 sectors, the ETFs that represent the 11 sectors of the S&P 500. And consumer discretionary had a good day. Financials had a good day. Industrials had a good day. These are typically the sectors that you want to see do well when you are bullish on the economy. And if you look at their lines between the red, the 52-week high and low, very little red here. I mean, industrials are right at their high. Communications, which is dominated by Facebook and Netflix, is right near its high. Materials off a touch. Energy off a touch. Utilities off a little. Consumer staples, worst performer of the day. Not a disaster, but that does show you that people are looking to get more into economically sensitive stocks, as opposed to stocks that are not economically sensitive. Okay, so let me start sharing the screen. Let me see who else is out there. Hey, Jerry, thank you. Jerry. Hey, Jerry, it was great to see you the other day, by the way. You and walking your dog. And I look forward to getting together with you and Lori and Judy very soon in person. We are so due for that. Now that the weather's nice, we can meet outside. We have no excuse to not do it. Okay. We've got a couple of comments out here. Rick is out here. Cryptocurrencies investing heavily might seem highly volatile, but we might just become pleasantly surprised within a few years. I'm not offering financial advice. Do your own research. Absolutely. Look, do you believe it or not? Right? And my reasoning is, maybe you have to decide for yourself how much exposure you want. I think just by having large cap companies, if you look at, for example, Tesla, Visa, PayPal, they're all one way or another gaining exposure to crypto. So directly or indirectly, you're probably slowly but surely becoming very gingerly exposed to crypto just by owning stocks. Yep, those are some of the cryptos. And I've grown my cryptocurrencies from a total of January 4,700 to just over 18,000. Good for you, Rick. I'm really happy for you. That is awesome. And it's fun, and you're having fun. So just keep in mind that there's other things like planning, taxes, insurance, and other parts of overall, wealth management, if I may say. So I want to reiterate something, and then I'm going to let you guys go. Just because something is going up in price doesn't mean that it's going up in value. You have to ask yourself, are you the type of investor who buys a security or a crypto because it's going up, and then you look for reasons to justify your purchase after the fact? Or are you the type of investor who does your research first and then decides whether or not to buy? That is two very different things for two very different kinds of investors. And that is something that you have to look within to figure out about yourself. Thank you so much for watching. And we are going to get going. I'll see you tomorrow.